And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Luke Smith, good afternoon. Welcome to the studio. I have never seen you so disorganised in all my life. What's gone wrong?
Everything. It's just one of those days where, you change the routine and bad things happen and...
Well, apparently you're in the process of making some changes, and one of the side effects of that was you had no internet for a little while, and so we've had no preparation time for today's program.
No, look, exactly right. And I knew earlier in the week what we were going to talk about, and I've been meaning to write it down, and then I'm in the throes of moving house, and the internet's gone, and then this is gone, and that's gone, and this was here and that one's there, and here we are.
And here we are. But we've got a cracking good topic nonetheless, because this is something, it's a bit of a brain teaser, this one.
Yeah, it is.
The very simple question opens up a can of worms, and the very simple question is this: what is a conservative investor?
Yeah.
Well, it's like how long is a piece of string, isn't it?
Yeah, look, exactly right. And I had a really entertaining appointment with someone this week, and let's say that person's name's Phil. Right, for the sake of changing names to protect the innocent. Phil came in and said, look, Lukey, here's what I got. Now, Phil had enough money for 14 generations. Right? Phil has crushed it when it comes to financial matters. Not only had Phil crushed it because, as we discussed in our appointment, he'd become an overnight success with 40 years of great behaviour. Mm-hmm. He'd been consistent, he'd been diligent, he was informed, he was obviously very, very good at what he did. And he even said in the appointment, well, this just sort of happened by accident, which was quite funny in itself.
Not really an accident.
Because he'd also lent some money to a family member and forgot about the number, and it was very entertaining. But he also looked at me with a very straight face and said, Luke, I'm a conservative investor. And I said, Phil, you hold 100% Australian equities, mate. And he goes, yeah, like it was nothing. And we both had a chuckle. But that then got me thinking, well, what makes something conservative? And what are the factors that influence the perception of the individual to make that comment? Because for me, and traditional wisdom says a conservative investor is risk averse. They want cash and fixed interest. They don't like volatility. They're quite happy to do as little as possible to be outside of the box in relation to loss. They're all the traditional components of conservative investing.
Yeah.
Yet it was really refreshing for Phil to say to me this week, yeah, I'm conservative with 4 or 5 bank stocks and some other key equities. And not only just Aussie equity, massive allocations in some individual holdings, to the tune of 15 and 20% of his portfolio, which, again, conservative and that level of weighting don't always go hand in hand.
Now, the idea of being a conservative investor would generally imply somebody who wants to minimise risk as much as possible. Yeah. Okay? Now, minimising risk would generally imply diversification. And that's what you're getting at, isn't it?
And that was was the funny part of it. Now, Phil was lucky enough that he had that much money. It didn't matter what happened. He couldn't really get it wrong. But I found it very interesting, and we had a very sort of robust discussion around the thought process of coming to that comment. And I found it very interesting that whilst there are a number of ways to look at something, it really sort of hit home to me that how you have your belief system set is going to impact the investment decisions that you make, the weightings to individual sectors, the exposure to individual holdings. They all talk to managing risk, asset allocation, individual issuer risk, sector performance. But it all really boils back to, what are you truly happy to understand? Now, Phil's situation was very unique in that it didn't matter whether a market went up, down, all around, or Father Christmas landed at Easter. It wasn't going to change how Phil lived. Now, a lot of people aren't that fortunate. So the movement in a market and the movement in a portfolio can have a financial and an emotional impact on how they feel and the decisions that they make. So I think we also need to preface this by saying, just because this worked for Phil, we're not advocating, well, this is now the new lens for conservative or high growth or whatever it is.
And indeed it really isn't. But I can understand where Phil's coming from. If you're going to principally invest in Australian shares because maybe you feel, it's risky investing in overseas shares. I don't know what's going to happen overseas.
Yep.
That's a bit risky. I'll just keep it to Australian shares. And then when you look at the Australian share market, sure, there are some equities that offer greater stability than others. And you pick your big four banks and a couple of big miners and a few other industrials, and you think, I've got my bases covered.
Yeah.
But it could all go wrong, couldn't it?
Well, and this is, again, part of... Again, we come back to what does conservative mean? And he had an example, and again, we had a chuckle because he had a particular investment that he had bought at, say, $5 that had gone to $1.60, right? So he'd absolutely killed it. That $1.60 is now also back at $15, and I made the point of saying, well, what if that happened to some of your other big holdings? Does the I wish I'd sold thought process make your tummy turn over? And he goes, yeah, it does. And I wish I'd. And he went, hang on, you got me. And we both agreed then that the way you look at being conservative is a multi-layered sort of lens, because you can hold great quality stuff, as you said. You can have 4 or 5 or 6 different Aussies that are very big and boring. That's not to say they're good, bad, or indifferent. But you also then need to think, well, even something that's great can come under pressure. So Cochlear, for example.
Well, Cochlear and CSL both have had a big tumble in recent times.
Absolutely carted out. Yep. But again, Cochlear especially, wonderful company.
Exactly.
And is off circa 60% from highs of a market valuation. Now, that's not to say there's anything wrong with it, because the lens that the world has for that particular investment at the moment, is a little bit blurred. And that happens with all assets over time. We saw the same in the Banking Royal Commission.
Yes.
They were monsters, they were terrible, and then as soon as we stopped talking about the Banking Royal Commission, things jumped 20% and we kept getting dividends.
And speaking of banking, a tremendous example of nobody knows anything is Commonwealth Bank. For years now, people have been telling us, experts have been saying it's overpriced, reduce your exposure, and yet the price keeps going up.
Yep, but then we also saw a level of normal come back into it. Yeah. And it fell from sort of 180, 185 down to 150. So again, nothing wrong with CBA, but we need to keep in mind with that conservative language being used, how would it make you feel? And do you have the risk tolerance and the stomach to ride those volatility swings regardless of the company that you hold? And Phil and I had a conversation then about, well, why didn't you go into other areas? And his immediate response was, I don't understand them real well, or I haven't been educated to a level that gives me comfort.
And again, that's reflected in the I'm a conservative investor. Totally. I only invest in what I understand.
Exactly. And that was the fun of the meeting. We had an hour and a half of just giggling and laughing, because it was a really good way of seeing the other side of people's philosophy and the basis to which they got to, which had a ton of merit.
Yeah.
But it also illustrates that you can look at this thing on a number of layers and not always end up at the same place, because we've said for many, many shows, what does balance mean?
Oh, that's right.
And this is the conservative end of that, which we both had a good laugh about.
So what are some of the alternatives here? If somebody has a substantial amount to invest, the sensible thing would be, by all means, place a section of your portfolio into Australian equities. But what are some of the other areas where somebody should be looking for a more risk-averse approach?
Yeah, well, again, that we come back to Phil's conversation. It was about there's nothing wrong with what you hold. It's just you are very top-heavy with some of these investments. And if we saw the pullback in the example that he had in the portfolio, he said it made him uncomfortable. We also then saw that as an opportunity to say, well, I've got the following tax events coming up and I need to sell some assets to pay pensions out of super. That was a great way to then use an upcoming capital event or a lifestyle event like taking an income stream as a way to pull down cash to meet what he needed. You could also then look to move into fixed interest investments. You could look to try and have an increasing allocation of listed property, commercial property, or international investments. And again, we need to then preface that by saying, what are we actually going into? Am I buying a CBA share, or am I buying shares in a diamond mine in Uganda? Right? Both shares, both might be listed Australian companies, both have a very, very different profile. And then we broke out, okay, could I use some ETFs to buy some well-diversified index exposures over saying, I'm just going to buy Tesla? And then we worked through that from a strategic standpoint, just to try and sort of give some spread. Because the Aussie market over the last 12 months has done about 5. US market's done 15 to 20, depending on what you're exposed to. And if you have currency hedging, it could have done 30. And again, we're highlighting, whilst you're being conservative, there are return opportunities on the table that in this example had just come about through just a lack of explanation and reading and knowledge. Again, which was just Phil's situation. The great thing about Phil was he said, well, I'm more than happy to learn so that I can benefit from said diversification, which was a really refreshing, view for him to have. But a guy that's successful, he's willing to learn and reads well.
Luke Smith from Envision Financial is with me in the studio, and we're talking about what does it actually mean to be a conservative investor. We'll be back with more in a moment. Luke Smith from Envision Financial is with me in the studio, and today we're asking the question, what does it mean to be a conservative investor? Well, I guess it sort of means whatever you want it to mean, doesn't it?
Yeah, look, I think it's open to interpretation, but I think, hopefully from today people can take what we've said and think about how it applies to them. It's like the old adage of balanced. Well, what does that mean? At the end of the day, it's a label. It's not necessarily a philosophy, because I also have a lot of people come in and go, well, I'm getting older now, I need to be more conservative. And I go, really? I go, you don't like money? They go, no, I like money. You don't want a lot of income? No, I need a lot of income. And you don't want growth to offset inflation? I'd like that too. I said, so where do you want to be conservative in a traditional asset allocation sense? And they look at me and they go, oh yeah, so what I've done for the last 25 to 30 years actually remains appropriate. Yeah. I had a conversation with another lady I look after who's 94. She came in recently and started hitting me up with, let's buy this, let's buy that. And I said, listen, darling, I said, no offense, you're 94, like just define long term for me. And because she's very sharp, she just leaned across the table and she said, listen, don't think you're not too big for a smack. So I think the important thing people can take from today is you need to understand how it affects you, the way it makes you feel, and the peace of mind that you're trying to achieve with your level of understanding at your situation. Because Phil was very happy to be extremely wealthy and have just Australian shares. People also come in and say, well, I want to be diversified out of certain sectors, in certain sectors. I want to manage individual risk. So it's important to understand how you feel, what you're trying to achieve, the level of volatility that you're willing to accept, and how it makes you feel. And I think also people's view of how brave and brash they are is influenced by their experiences. Pre-GFC, pre-COVID, pre-tech bubble, you have the risk profile of a drunken rhino. Luke, I can tolerate anything. And the same person calls in the middle of COVID going, so I think timing and experience is also a key contributor to how you relate your experiences to the philosophy that's appropriate for you. And I think people need to scrape a little bit under the surface there and sort of think about that themselves. Because I can have a view of balanced, I can have a view of conservative, and I can have a philosophy. But my philosophy needs to be your philosophy for it to work. Otherwise, we've got one car going left and one car going right. So I think people can get a lot today, whilst it's been very tongue-in-cheek, it's actually far more important that they understand how they feel. Because filling out a risk profile questionnaire and all of the sort of guff that goes with that only gives you an indication of how you would react. And I think everybody reacts differently. Like I say, a mini will not pull a horse float. Super funds are not all the same, nor are people's understanding, education and experience in an area that is extremely important to them, because it's generally their largest, if not their second largest asset in their working life that is there to fund them forever. So, think about what it means to be conservative for you.
Exactly right. Now it's time to ask the most important question of all. Where can people get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the strategy stack of Luke Talks Money on iTunes and Spotify. And we have Envision Financial Canberra on YouTube. And we have entire section of Smart Money Strategy, your ultimate guide to financial planning, on investing, asset allocation, and what it means to be conservative.
Fantastic. And, of course, we'll be back again at the same time next Friday afternoon with another discussion of equally important financial considerations. Thanks very much for popping by today.
See you next week.
Thank you. Luke Smith from Envision Financial, back with us at the same time next Friday afternoon.